out with a report that came out maybe last week, basically upgrading Asia EM equities, maybe that we're seeing signs of a trough here right now. Jonathan, great to talk to you. We spoke to you just about 3 weeks ago. You said not quite there yet. What's really changed in your eyes now?
Well, in our view, we are now at or around a trough, and we had major declines in middle of August all the way through to the end of September, which took us down to some exceptionally low valuations, about 10 times forward PE for the EM index. That's actually below where we troughed in the COVID recession or 2018. It's one of the lowest multiples we've seen other than the global financial crisis. And at the same time, some of the internals within the market, particularly the underperformance of Korea and semiconductors, took those markets to really exceptionally low valuations.
Are there, what sort of response have you gotten from clients right now? I think it's quite a bold call to be saying that maybe we're seeing a floor now, just given the macro weakness that we've seen. As people are talking about a tech downturn after that Samsung earnings that came out on Friday as well. What are some of the near-term risks to that sort of conviction that you have now?
Yeah, so this is a call out through the course of next year. It's a big call from us. It's sort of analogous to the downgrade we did in early 2021 on EM and China. And there's an enormous debate. We've been exceptionally busy in responding to client inquiries about this. I guess you've covered a lot on your show, just listening to the intro before I came on about the bad news that's out there. But markets tend to trough on bad news when it's abundant. There's a lot of debate about the direction of Fed policy, the dollar and the S&P, and then obviously, again, how China after the Party Congress is going to evolve.
And what are you expecting for the Party Congress coming up this weekend as well? People are saying that maybe we'll get some signs of maybe the easing of COVID zero policy. Is that just wishful thinking?
I would say that in terms of market expectations, there's much less optimism than there was in the summer. And we would agree with that. We're very unlikely to see any kind of big bang easing, but a gradual easing of approach over a matter of months, which leads to a pickup in growth from really very low levels now. I think that's a reasonable base case. And don't forget, on the property side, we've already got some important measures that are flowing through to actually clear the inventory and to enhance, for example, some of the developers in terms of their ability to issue credit onshore. So there is easing in the pipeline of a more conventional form in China already.
And can you walk us through, you mentioned that there's been a lot of debate. Do you think EM can still recover if U.S. markets are still kind of seeing a lot of pressure here and what we're seeing across DM?
Yes, we do. A really key part of our report is to understand that EM equities are early cycle, and within EM, Korea and Taiwan, the two markets that we're bullish on, and the semiconductor and tech hardware stocks, they have a track record of troughing on very bad news, like those Samsung operating numbers that you mentioned that came out actually after we wrote our report. But that idea that actually the worst of the news now is Q3, Q4 this year, and when we're in the second half of next year, the year-on-year comparables will have inflected back up again. That's why we think stocks are troughing. And we've managed to trough in EM 4 out of the prior 10 markets before the S&P, including most recently in the 2018 cycle when EM equities troughed at the end of October, but the S&P didn't trough until the end of December. And there's some quite important analogies between now and then in terms of the debate about the Fed, how long will they carry on hiking, and how long will they carry on doing QT.
Where you mentioned the rotation to tech, just walk us through a little bit more about how you are advising to APME's investors on where they need to be shifting and changing the portfolio sector by sector.
Yeah, so given that we're upgrading two very large markets and one huge sector, the whole semi-tech hardware sector, we're downgrading elsewhere. So we're recommending taking profits on overweights on Indonesia and Singapore, two defensive markets that have hugely outperformed year to date. We're taking those down to neutral. And more controversially, we're putting in place an outright underweight on India. India is really in a completely different valuation paradigm from the rest of our coverage. It's trading at the 95th percentile of its forward PE range, about 22 times forward PE. That means versus, for example, Korea, 2.5 times the multiple. That's a record valuation premium for India relative to Korea.
This news, Jonathan, how does that impact, I guess, your call about upgrading tech in Asia?
Yeah, I think there's a number of points to make about this. Firstly, we've been going through this for almost 4 years now since the Trump administration. So we've had things that have been very stock specific on multiple occasions in the past that have affected particularly Chinese equities. If you look at, as your correspondent was saying, what's really going on here, it's about the high end of chip manufacture with very specialized sort of processes and techniques, and in particular the semi-equipment names, which are more represented in the SOX index than they are, for example, in Kospi or Taiwan. And again, I would say that if you look at China itself from a growth perspective, it's very different from a few years ago. It's contributing only mid-single digit to global growth right now. So if you actually look at where global growth is coming from, well, it's really coming from the US and some other parts of EM, like India and Indonesia. So in terms of future growth for chip products, China is not as central as it was a few years ago.
How does China fit into that call that you have about this rally that we're about to see in EM in particular? And the tech sector, as you mentioned, how much conviction can we have? And are valuations at least cheap enough for you to maybe start nibbling at that sector?
Yeah, valuations in China are, again, extremely cheap. 9 times forward for MSCI China. At the Asia financial crisis low valuation for Hang Seng. In terms of the actual performance of the market going forward, a lot will hinge on what we covered in the previous segment, how we come out of the Party Congress. Within the China market, we're still broadly cautious on big cap internet names and private sector names that have been impacted by regulatory reset. And that's why, in terms of actually the call that we're making, it's really leading with Korea and Taiwan and waiting a bit to assess the situation in China on multiple dimensions, one of which, of course, is geopolitics, US-China relations, and things like this action for Chinese importation of advanced semiconductors.
How does the dollar kind of change, or maybe does it change in any way, to give you such a more optimistic outlook when it comes to EM? Are we seeing signs of a peak on the greenback?
Yeah, the dollar has been exceptionally strong. In fact, on some measures, it's at a 40-year high. I think what's important here in Asia is that the corresponding weakness that we're seeing, for example, in the Japanese yen, the Korean won, the Taiwan dollar, these actually help margins for the big cap exporters from our geography, just at the same time as they damage margins for some of the constituents of the S&P 500. So these moves have been so large that whatever your debate is about top-line revenue growth and where the global economy overall is going, there's going to be some sort of different cutting of the pie, as it were, in terms of corporate profitability that arises from these dollar trends.
And you mentioned about Japan. How does a weaker yen then, impact your view? I mean, you mentioned Japan is one of your favorite markets right now.
Yeah, we've had Japan as a defensive overweight this year, FX hedged. And we made one change in our note last week, which is to recommend taking off the hedge for the dollar-based investor. Now, we can clearly see the Bank of Japan intervening to slow the pace of decline of the yen for the first time since 1998. But FX hedged Japan equities are actually up year to date, so have proved to be defensive, along with markets like Indonesia and Singapore. Japan's trading about 12.0 times forward PE, so that's basically at a 10-year low, and also very cheap relative to S&P 500, with that tailwind for the exporters of the yen weakness we've already had.
Does that, unhedging things for currency, I mean, does that sort of apply for all markets across EM in Asia as well? Because we continue to see a lot of weakness across a lot of the Asian markets that you cover.
Well, as Japan is a major developed sovereign with highly developed financial markets, and as Japanese rates are so much lower than US rates, you're actually paid to hedge the yen this year. So it actually adds to dollar returns to have the hedge on. It's not possible to hedge in large size some of the currencies that one has here in Asia, such as, for example, Indonesian rupiah or even Indian rupee. So we don't typically make currency hedge recommendations except for Japan, which was a big call for us until last week.
And so, I mean, it gets to my earnings then, your outlook as well. Obviously, FX is going to be one of the key factors we're watching out for. What are you watching out for in the quarter? Things are looking pretty depressed. Are we seeing any signs of maybe things are looking a little bit more, maybe brighter?
Yeah, we're looking for a really, really bad quarter. And as I mentioned to you, with names that we put in our focus list last week, like Samsung Electronics, LG Display, SK Hynix, even TSMC, we're anticipating the third quarter just passed that will be announced, and the fourth quarter will be the trough in what are very cyclical markets and stocks. So to that extent, the debate with clients is just how bad are things now, and will we get a normal cycle versus an alternative view that maybe we enter like a multi-year slowdown in tech spending. Now, that is too extreme a view. It's the inverse of where many people were in early 2021, where they weren't anticipating the cyclicality that was caused by the brought forward demand for these goods during the COVID recession. So again, our whole pitch is that normal cyclical forces will work going forward, and we're actually in the worst of it right now, and we'll be in a much better place the second half of next year.
And it was interesting, Mike Wilson, your colleague in the U.S., talked a little bit more about, even if inflation comes down in the U.S., earnings-wise and margin erosion is still something to look out for because demand picture is not looking too good now. And you're still seeing a lot of companies' inability to kind of pass on those costs. Are you seeing any of that in Asia, Jonathan? Are we likely to see margins improve in any way?
Well, the US is, to some extent, the inverse of the situation here. Its economy's still, until very recently, been strong. In some segments, it is clearly slowing, i.e. semi and tech in the third quarter. But the dollar strength is the clear inverse of currency weakness in Asia. And so that important point of differentiation is why we are actually upgrading here, whilst Mike remains cautious on the outlook for the S&P. And that kind of dynamic has happened before. As I mentioned earlier on your segment, 4 out of 10 prior bear markets, Asia and EM, have troughed before the S&P 500. But with the additional kicker of just how extreme the dollar behavior is, there's an even greater chance that when we actually get the numbers as we go through next year, our stocks in Asia semis and tech hardware are actually posting some pretty good numbers off the basis we have in the third and fourth quarter this year.
Jonathan, thanks very much for joining us. We have one last question, our MLI Pulse question that we've been asking all of our guests is, where is the next recession? Where do you see the signs of a recession? I know, Morgan Stanley has a kind of different take on the whole recession call right now.
Okay, let me be very clear about this. The Chinese economy has been in a recession for some considerable time. You can see that in particular in the way that unemployment has risen. Europe is going into a recession in aggregate, and some parts of the US economy have moved into recession, particularly in the semis and tech space. So this debate to some extent is over. We are in some kind of global recession as of the third quarter. The question is, how do we get out of it through the course of next year? And that gets to obviously the debate about the Fed, but also the kind of actions that a myriad of corporates will take in terms of reshaping their businesses, which caused the business cycle in the first place. So yeah, the debate about are we going into a recession or not is over. Everything that we see indicates that we're in some kind of recessionary environment as of the third quarter, and we'll get a lot more of that as companies announce over the next couple of weeks.